Okay, we're going to turn our attention now to a business risk question. We've looked at audit risk by looking at a question called Shire Oil, but business risk questions also come up on the exam. Typically, a business risk question can then be taken in one of two directions. Either we get a business risk question where you identify the business risks and then have to advise the company on how best to manage those risks. Now, that's not really an audit question, that's an other services or other assignments question, because we're not checking the financial statements at all. And then the second type of business risk question, which is what we're going to look at, is where we identify business risks and then we're asked how that could impact on the audit that we're about to do. So, what we're going to do then is take a look at this question, which is back from December 2003, and see how we get on. So, this question is called Hydrosports. As I said, it came up on the December 2003 exam, and therefore, if there are any dates in the question, we should take that into account. Well, as always, the first thing we're going to do is take a look at the requirements and see what the question asks us to do. We're going to focus heavily on the risk-based bits of the requirements, which are the biggest bits, but there are some other things in the question as well, and we'll take a brief look at those too. So, quite a few things to do here in this 30-mark question. And part A, part 1, says identify and explain the business risks, which should be assessed by the management of Hydrosports, and that's worth 8 marks. That probably means we're looking to find around about 8 risks to this company. So business risks are risks to the business. What could go wrong for this organisation? A part 2 then says, explain how each of the business risks identified in 1 may be linked to financial statement risk. That's also worth 8 marks. So in the first part of part A, it's risks to the company, its future profitability. And then in the second part of the requirement, financial statement risk, or in other words, why might their accounts be wrong as a result of the business risks we saw in part 1. With parts 1 and 2 clearly linked, everything in 1 will hopefully generate something in part 2. It may be wise to do a 2-column approach in the answer, so that everything on that side has a corresponding point on that side. Part B then says, describe the principal audit work. So just as we saw in the audit risk question, we're then taken on to look at the actual audit work we propose should be done. To be performed in respect of the carrying amount of the following items in the balance sheet, which of course, if you're doing international stream now, would be the statement of financial position of Hydrosports as at the 31st of December 2003. So here are 2 numbers that would appear in assets or liabilities, and we've got to describe principal audit work. Well, audit work will be analytical or inquiry or inspection or observation, etc., etc. And there's only 3 marks for each of these, suggesting we may only need 3 good, solid pieces of audit work. B part 1 says deferred income. Well, before we read the story, let's make sure we know what deferred income is. Otherwise, we may not spot the deferred income in this particular situation. Deferred income is where an organisation has received the income, but the income relates to goods or services that will be provided to customers in the future. So they've been paid up front. So if a customer prepays, the customer has a prepayment, the supplier has deferred income. So as we read through the story, we'll need to look out for where people are paying in advance for something. And the other thing we have to do is some principal audit work for a hydrotherapy pool. Now at this stage you might be wondering what hydrotherapy is. Well, hydro means water and therapy is something typically that doctors do for you. It's some sort of medical service to help you relieve pain. So hydrotherapy is going to involve some sort of reduction in people's pain through the use of water. We're about to find out that this company has a chain of leisure centres. The leisure centres are based around swimming pools. So hydrotherapy pool is going to be a special swimming pool which somehow provides relief from people's pain. The chances are, therefore, it's a fairly small pool with jets of water coming out which are aimed at muscle groups and relaxing and things like that. But you don't really need to know that. Whether it's a hydrotherapy pool or a pool, it's a pool. A pool is typically, if you're in a leisure centre, a big hole in the ground full of water. Whether it's hydrotherapy or not is only a minor part of the exercise. As an auditor, what audit work would you do regarding the carrying amount, the value in other words, in assets of a swimming pool? If you can answer that question, you should be able to get 3 marks fairly easily here. Now, before we get too excited about this, don't forget there is a story, and the story is likely to tell you things about this pool, which might highlight particular issues to do with its value. On this exam, the one thing I've noted when it comes to asset valuations is that the examiner's main point is almost entirely impairment. So when I'm reading the story and when I come across this pool, I'm going to be asking myself, is there any clue that the value of the pool has been impaired? I can't guarantee that will be the main issue, but virtually every example I can think of, it is the main issue. The final part of the question is very similar to what we did with the audit risk question, Shire Oil. It says suggest performance indicators to increase the centre manager's awareness of Hydrosport's social and environmental responsibilities and the evidence which should be available to provide assurance on their accuracy. 8 marks. We're looking for social and environmental, so maybe that splits the 8 marks 4 and 4, and we need performance indicators and evidence for each of those. So in fact, part C is probably not an 8-mark question, it's 4 2-mark questions. But let's go back to part A, read through the story and see if we can spot some risks to this company. Now, of course, in the exam, you will use a ruler when drawing these lovely lines. A Part 1 business risks, A Part 2 financial statement risks. The financial statement risks have got to link back to the business risks, so a 2-column approach would seem to work. Now, as always, I'm going to be planning my answer rather than writing it out in full, otherwise it takes a very long time both to write it and explain it as we go. So, let's see what we can find. Don't forget, we're looking for 8 marks in each column, so I'm assuming 8 risks. Okay then, Hydrosports, a limited liability company and national leisure group, has 16 centres around the country and a head office. Facilities at each centre are of a standard design, incorporating a heated pool, sauna, air-conditioned gym and fitness studio with supervised childcare. Now, I can see a fairly long story in front of me, but if you're at all worried that you won't find enough risks, let's just have a think about the nature of this business and how that might create risk. We won't note any of this down, we'll just think it in our heads at this point, so if we haven't got enough risks at the end, we can add these more general ones in. So here is a company that runs 16 leisure centres, which have swimming pools, gyms, sauna, etc., etc. Well, what could go wrong with all of that? Well, when I think of swimming pools, I think of the risk of accidents, I think of the fact that swimming pools have chemicals in them, and that might cause people illnesses. And I know that swimming pools are very good at spreading illness and disease if they're not kept clean. All of those are risks to the reputation of this business. When I think of air-conditioned gyms, I think of a lot of fit people. Of course, if anyone goes in there who's not fit enough, they might overexert themselves, and that could give rise to accidents as well. When I think of saunas, I think of very hot things, and very hot things can cause accidents as well. And it also says supervised childcare. As a parent myself, I know there are a lot of rules when it comes to looking after children. So I must suggest at this point that there is a risk that this company might break some of those rules, all of which would be a risk to its business. So if I'm stuck for ideas at the end, I can already think of a few things that could go wrong for these guys, but let's deal with what it actually says in the question first of all. Each centre is managed on a day-to-day basis by a centre manager, in accordance with company policies. Nothing too exciting in there, I suppose. The centre manager is also responsible for preparing and submitting monthly accounting returns to head office. Now, that must be a potential risk. Presumably, when head office are monitoring the financial performance of each leisure centre manager, they're going to be relying on the facts and figures supplied by the leisure centre managers, who must therefore have a very big incentive to send back figures that look really good, to make it look like they're doing a good job. That could then lead to head office keeping a leisure centre open, even though it's making losses, because they don't have the correct numbers. Now again, there's no evidence at the moment that centre managers would be doing that, but I've got that in the back of my mind. If there's anything else in this story about the centre managers, maybe that point needs to go into my answer. Right, now we've got past the first paragraph, which is typically setting the scene and just giving you a few thoughts about what this company does. We move into paragraph 2. Each centre is required to have a licence from the local authority to operate. Well, what could go wrong with that? Well, if you have a licence, licences can be taken away. And also, if you have a licence, it's normally for a period of time. In this question, it says between 2 and 5 years. And they're renewable subject to satisfactory reports from local authority inspectors. So another risk is not that your licence is taken away, but that when it comes round to renewing it, they won't renew it. Now, a little tip for financial statement risks. From my experience, the main things I find myself writing in answers are impairment of assets, failure to provide for things, under provision in other words, and going concern problems. But we should also take care because virtually any business risk could create going concern problems, because that's what a business risk is, a risk to the going concern status of the business. So we don't want to say going concern too often in the answer. Well, if a licence is not renewed at one of the leisure centres, that's a fairly clear business risk. You'd obviously lose members to other competitors. And obviously, there'd be reputation damage and people starting to question, well, if that leisure centre has been shut down because it's lost its licence, and if they're the same facilities at each centre, does that suggest that the other centres aren't particularly good? But what about the financial statement risks? Well, if you don't get your licence renewed, the most obvious financial statement risk is the damage to the business could lead to going concern problems. But a going concern threat is the business risk. How does that affect the accuracy of the financial statements? Well, if there's a threat to your going concern position, you're meant to disclose that in the financial statements. If several centres lost their licences, this could extend into this chain of leisure centres not being a going concern at all. And if you believe that this company is not a going concern, the company should not be disclosing that in a note. It should, in fact, be preparing its financial statements under a completely different basis. So that's the licence not being renewed. And I suppose if a licence was actually taken away before it even finished, maybe due to poor performance or breaching terms and conditions, breaking the law in one of the centres, you'd get pretty much the same issue, but there would be an additional problem as well. Because now you get the same risks, but you get an additional financial statement issue. Because if you've got, say, a 5-year licence, that is an intangible asset on your balance sheet, on your statement of financial position. If it's now taken away from you, and it had, say, 3 years left to run, well, its net book value is now 0, which means your intangible asset, which presumably with 3 out of 5 years left to run, is valued at 3/5 of the cost of getting it, is overstated, because it's been impaired. Now, in fact, when we read the question and we look at the numbers involved here, the cost of a licence is not a huge figure, and so the chance of this being material is probably fairly small, but still worth a brief mention. Now, back to the question. Let's look for some more business risks. Members pay a $100 joining fee, plus either $50 per month for peak membership or $30 per month for off-peak, payable quarterly in advance. Well, that would appear to be the deferred income. They're paying in advance, so the leisure centre has the cash, but hasn't actually supplied gym services yet. So at the end of each year, the final quarter payments being made by members might, partly or fully, be payments for next year, not this year. Now, that is what Part B of the question is about, so I'm assuming that's why the information is here, and we'll worry more about this in Part B. All fees are stated to be non-refundable. Well, if they're non-refundable, that would suggest there is a risk that the company might have taken those fees as income this year, even if they relate to next year, on the basis that if they're non-refundable, the money's been earned. There's no risk of it going back. But we know that the matching principle says that you should match your revenues against the costs of creating those revenues. And surely the cost of creating the Gym membership is in supplying the gym services during the quarter 3-month period that the person is a member. We should also take that non-refundable point a little carefully. A lot of companies say, oh, it's non-refundable. If the company then fails to provide the services that you've paid for, it certainly is refundable because they've breached their contract with you. Okay, the centre at Verne was closed from July to September 2003 after a chemical spill in the sauna caused a serious accident. Although the centre was reopened, Hydrosports has recommended to all centre managers that sauna facilities be suspended until further notice. So we have an accident, and now we have 16 leisure centres who've taken their saunas out of operation. What are the risks to the business? Well, any members who like to have a sauna are presumably not going to bother renewing because they can't get saunas anymore. In fact, they might even try to demand their money back on the basis you're not providing the services you said you had. That's clearly a risk to the business. The company is going to lose members, lose money, and suffer reputation damage. On top of that, the accident will cause reputation damage, and if it's a serious accident, you would assume is going to lead to some sort of compensation payment, maybe even a court case regarding the person who was involved in the accident. So, business risks. Losing members and reputation damage, as mentioned before. There's a compensation claim, I would imagine, and also, I suppose, the costs of actually trying to fix the sauna, and since they're all of a standard design, checking out the other 15 saunas to make sure they're okay. Now, all of that lost revenue, damaged reputation, and increased cost is, of course, a problem for the company, and therefore a clear business risk. But what about the risks of the accounts being wrong? Well, the compensation claim, if there is one, may not have been provided for, or if it's in its early stages, maybe it's a contingent liability that should be disclosed. And then, of course, there's the sauna itself, and potentially you could argue all 16 saunas. These are assets, tangible assets of the company. At least one of them is damaged and therefore surely impaired. And if the other 15 are of a similar design and potentially now not usable, well, if they're not generating revenues, they're impaired as well. And of course, all of this damage to the company is yet another potential going concern risk, depending on how bad the reputation damage is and the additional costs and the compensation claim. Now, I'm not bothering to explain the going concern threats to the financial statements again, the risk of under-disclosure or even preparation under the wrong basis, because it's exactly the same explanation as before. Going concern is a general accounting issue that affects the entire set of accounts, so once you've mentioned it once, only mention it briefly again because you'll just be repeating yourself. And we know we can do this because when this question came up, that's exactly what the examiner did in her model answer. Right, back to the question then. In response to complaints to the local authorities about its childcare facilities, so as suspected, childcare full of legal issues, and already they're getting some complaints, Hydrosports has issued centre managers with revised guidelines for minimum levels of supervision. So it would appear that they have not had the right level of supervision in place. That could lead to legal claims against the company. Centre managers are finding it difficult to meet the new guidelines and have suggested that childcare facilities should be withdrawn. Well, how can all of this affect the business? Well, what sort of members would need childcare facilities? Presumably, parents who wish to use the facilities, maybe during the daytime when their husband or wife is at work, and therefore have to bring the kids along as well. So some of your members may now not be in a position to use your facilities anymore, which means you're going to lose members. In fact, again, maybe some of them will demand refunds. There's also the reputation damage from withdrawing this service, and also potential fines and penalties if you've not been meeting the law so far. So some fairly clear problems for the company if they do this, but what about the financial statement issues? Why might the accounts be wrong? Well, if they have been breaching laws and penalties are about to be imposed, those should be provided for, so there's a risk of under-provision. If a lot of their members rely on this service, and if reputation damage is great, I suppose it could even lead to going concern problems. And if some members are now entitled to a refund, because it says in the terms and conditions that childcare is available, and now you withdraw it, and someone's already paid in advance, presumably there is also a potential need to provide for some refunds. So you can see from the answer that we're developing here that the business risks are not too difficult to find. All you have to do is read everything in the question and ask, what damage could that cause the business? The financial statement risks require a bit of thought. You've got to think about why the accounts of this company might be wrong, but notice how repetitive it's getting. Going concern, under provision, impairment of assets. Now those won't always be the issues, but they do seem to crop up a lot. Back to the question. Staff lateness is a recurring problem and a major cause of early bird customer dissatisfaction, with sessions which are scheduled to start at 7 in the morning, 0700 hours. Now the early bird catches the worm. Early birds are people who are up and about early. So I suppose some members might like to go very early in the morning, use the facilities maybe, and then go on to work. Well, if you turned up at the gym that you've paid money to join, and this will be peak time, of course, and you find that the doors are locked because staff haven't turned up, what would you do? You'd tell all your friends how bad the gym is, reputation damage, and presumably you'd start demanding a refund. Now bear in mind, if you take away childcare facilities, you're in danger of losing single parents. And if you take away the early bird, in other words, you don't open on time, you're in danger of losing those people with jobs who have to go in early. So you may now have caused reputation damage to two different sectors of your membership, which is an extremely dangerous thing to do. The refunds, again, could lead to under-provision, failing to provide for enough of those refunds, and reputation damage and losing members. Is yet again a going concern threat. New employees are generally attracted to the industry in the short term for its non-cash benefits. You could imagine that working at a leisure centre you probably don't get paid very much, but you do get to use the facilities for free, probably. But they leave when they require increased financial rewards, so there's high staff turnover. Now that, of course, can lead to business problems. New staff don't understand the rules, don't understand health and safety, and the risk of accidents goes up. Training staff to be qualified lifeguards is costly and time-consuming, and retention rates are poor. Well, that's a business risk, isn't it? You've got high staff turnover, your staff need to be trained, which means every time someone is replaced, additional training costs, and additional risk that there are lifeguards monitoring the pool who are fairly new and not yet properly trained. Now, if you're a swimming pool and you have untrained staff, there must be a risk of prosecution. There must be rules about the appropriate number of people monitoring the pool at a time. And increased training costs, you could argue, is yet another potential going concern threat. Back we go again. Turnover of centre managers is also high due to the constraints imposed on them by company policy. Now don't forget, those centre managers are sending in the accounting information. If there's high staff turnover, are they trained properly? Are they sending in inaccurate figures because they don't know how to do them properly, or maybe they simply don't care? So yet again, more going concern threats. In fact, in a more general sense, having people managing leisure centres who are fairly new, therefore inexperienced, and maybe don't care that much because they're already planning to leave, can't be good for business in a general sense, can it? And it's no wonder that other staff are leaving if the person managing them doesn't really seem to care that much. 3 of the centres are expected to have run at a loss for the year due to falling membership. Well, there are 16 centres, so if 3 are running at a loss, there are another 13 which presumably are not doing too badly. So I'm not going to get too excited about that point. Hydrosports has invested heavily in a hydrotherapy pool Now that's coming up in part B, isn't it? At one of these centres. So they're building a pool, a specialist pool, in one of the centres which is running at a loss and where membership is falling. Well, that wasn't a very clever decision, was it? Surely you'd want to build this pool in one of the better centres, where membership is rising. Of course, they may have made that decision because they were being supplied with the wrong information by the centre managers. Who knows? With the aim of attracting retired members with more leisure time. The building contractor has already billed twice as much and taken 3 times as long as budgeted for the work. The pool is now expected to open in February 2004, so just in the new year. What's the risk to the company? Well, they've massively overspent and taken far too long building a pool to be used by people at a centre where membership's actually falling. What could go wrong for the business? There aren't enough people to use the pool to make it profitable. This could be a massive drain on their cash flow resources. Now, obviously, if you're spending a lot of money and you're also making some losses, there is a danger to your going concern status here. But there is another point. This pool is an asset. It will therefore be sitting, as we know from Part B, on the balance sheet, on the statement of financial position. It is an asset under course of construction because it's not finished yet. What financial statement risks does this create? Well, the asset would typically be recorded at the cost incurred so far. When you finally finish it, the full cost will be sitting there, and then you would depreciate it over its useful economic life. But assets can only be held at a maximum of their recoverable value. In other words, the revenues you will generate from using the asset. And you either do that by using it in your business to generate profits or by selling it. Bearing in mind this pool is a hole in the ground, it's going to be rather difficult to sell it because, of course, it's a hole in the ground and can't be moved. So, this company will generate profits by people using the pool. Are there any clues that these profits are reducing? Or in other words, is there a risk the pool is already impaired? Well, you've spent far too much time building it, it's late, and membership is falling. So there must be a risk that you're not going to get enough revenues back to cover the cost of building the pool. In which case, it certainly has been impaired. So, amazingly, this pool may already be impaired and you've not even finished building it yet. Now, if this is the belief, if we can prove that this is true, bear in mind this will have an impact on your audit work in Part B, and it also means that every other dollar spent on building that pool should go to expenses, because you won't get that dollar back. Cash flow difficulties in the current year have put back the planned replacement of gym equipment for most of the centres. Well, if you've got gyms where people go to exercise and you don't replace old equipment, what's likely to happen? Some members go to gyms where they do replace the equipment. Increased accidents, so reputation damage again. Now, all of those are fairly clear risks to the business. What about financial statement risk? Well, I suppose yet again we could say going concern threats if enough members leave. But there is another issue for the financial statements here as well. The gym equipment, again, that's assets, tangible assets in this company's balance sheet. If you are not replacing them at the normal speed, you're going to hang on to them a bit longer. What's the financial statement issue? Well, now there is a risk that these assets are understated on your balance sheet because you'll depreciate them down to zero, but you'll still be using them. So your depreciation policies are now wrong because they're too quick. Now that's fairly rare. Normally our concern is that assets are overstated, and it just goes to show that you must keep your concentration level up when doing these questions. I've said impairment is a key issue and it comes up a lot, and we've seen that already, but sometimes it can be the other way around. And finally, insurance premiums for liability to employees and the public have increased by nearly 45%. Now that again is another drain on the cash of the business because you have to pay for the insurance. It's probably part of the terms and conditions for having your licence. Hydrosports has met the additional expense by reducing its insurance cover on its plant and equipment from a replacement cost basis. In other words, if your plant and equipment is damaged, the insurance cover will allow you to buy some new stuff, to a net realisable value basis. Now let's have a think about this. If you've got some old plant and equipment that works just fine, well, that's good. But does it have much value if you were to try and sell it to someone else? Possibly not. Which means, of course, the amount you get back from insurance if it goes wrong or is damaged might be such a small sum that you can't actually go and replace it. Unless you can find another company with similar equipment of a similar age who are looking to sell theirs at the same time. And I'd imagine it's fairly specialist stuff and it's hard to buy it second hand. So you may have to go and buy new stuff and suffer an additional loss. So they've taken an additional risk because their cash flow position has forced them to do so. But of course, the danger of taking additional risk is it might come back and hit you in the face. Financial statement risk? Well, I suppose the most obvious one here is going concern again. So there we go. That's part A, the biggest part of the question. We needed to find 8 risks. And as you can see, we found more than 8. So as long as you read it through carefully and challenge everything you're asked and think, but why might that damage the business? I don't think this is a desperately difficult part A of the question. Now, we're going to move on and have a quick look at part B. We need to do some audit work on deferred income and that hydrotherapy pool. So let's have a think about technique. Now, when I think of audit work, as we saw in the Shire oil question, I think of a couple of useful lists. I think 5 main types of audit work: analytical, inquiry, inspection, observation, recalculation. So I'll just note A, E, I, O, U up there to remind me of that. And I think of 5 types of evidence. And for that, I think documents, assets, directors, accounting system, and third parties. So a couple of useful idea generation lists for me. And the first thing I need to do is audit work on the deferred income. Well, the deferred income is where people are paying quarterly in advance, but some of that relates to membership after the year end. So the year end is the 31st of December. I suppose if someone is paying quarterly in advance in November, that payment might be a renewal covering December, which is in the year, January, February next year. So 2/3 of it is therefore deferred income, a prepayment from the customer. So, AEIOU. A, analytical, involves comparing things. Well, if members have always paid quarterly in advance, I suppose comparing this year's deferred income with last year's deferred income would make a lot of sense. We'd have to take into account changing membership numbers, and also if they've changed the actual price of membership, that would have an impact. But comparing this year with last year, maybe on a centre-by-centre basis, in case one centre manager has managed to screw up the calculations, would make a lot of sense. Well, that's a fairly sensible test to do then, a bit of analytical. There is also another cunning analytical thing I could do. Now, this is a little oversimplistic, but the basic principle works. Generally, anyone paying in late October is going to be paying for November, December, January. So 1/3 of their payment relates to next year and is deferred. In November, people are generally renewing for December, January, February. So 2/3 of their payment is deferred. Well, when people pay things, it goes through the cash book. And a cash book has got columns added up. So why don't we go to the cash book in October, November, December and do this? Now, it's probably a little inaccurate. If someone is paying in early December, they might be renewing partly for December, of course. But that should give us a rough guide as to what the correct figure on the balance sheet should be. Well, I'm looking for 3 pieces of audit work, and there's a couple of pieces. A, E, I, O, U. Can't really see the point of asking anybody, and I think as an individual I'd be surprised to receive a letter from the gym's auditors confirming I've paid. Inspection, is there anything we can look at? Well, in order to do these calculations, which might be quite complicated, we probably need to look at a member's membership records, probably on a computer, to check the day they joined and therefore to be able to do a recalculation of that percentage of their payment which should be deferred. Now, the first 2 tests I did were analytical and looked at the total figure to see if it looked about right. Of course, another way of auditing is to take samples and test individual items. So take a sample of membership records, make sure that the member is up to date, and then so we could do it on a sample basis and check a few members out. Now, I've got 3 answers here. It's actually quite difficult to think of that many things you could do here, but there are 1 or 2 others. After all, if all these membership records are on a computer, deferred income is just a mechanical calculation. If you joined on the 14th of November and you pay for 3 months, roughly half, 1.5 months, relates to next year, so surely a computer is probably calculating the deferred income in the first place. And if that is the case, instead of me checking the figures manually, maybe I could use some computer-assisted audit techniques to see if the computer's doing it right. For example, I could set up a new member on the system, put in a start date, manually calculate the deferred income, and then see if the computer gets it right. That's called test data. Or alternatively, I could use an audit software program to interrogate my client's system and check the way it's doing it. But we've got our 3 marks by now, and we need to move on to the second bit and look at the hydrotherapy pool.